So as we're sitting down, let me introduce Vanessa Grellet, I couldn't think of a better person to introduce this panel, to moderate this panel. She's a true OG, has been in the space for a long time. I've been holding important roles at Consensus. She was portfolio manager at CoinFund, and right now, managing partner at Aglaé Ventures and Arche Capital. Vanessa.
Thank you so much, Guillaume. Super excited to be here with this amazing panel to talk about how to bridge the gap between TradFi and the crypto natives. I'm going to let all my panelists introduce themselves in the details that you want, but also highlight what they are doing exactly in the space to bridge that gap, or what's their perspective. And then we'll take it to a conversation. Stef?
Stef, at Keyrock, one of the major LPs in the space, crypto native, a power user of stablecoins, liquidity provider on stablecoins. Liquidity is essential, especially for bridging the gap. So, major market maker.
Anthony DeMartino, I'm the founder and CEO of Trident Digital. We focus on stablecoin adoption on chain, specifically for US dollar stablecoins and non-dollars. No yield-bearing ones yet. And we also are working on building out a lending platform.
Hi, my name is Lily Liu. I'm the president of the Solana Foundation. This is my 10th year in crypto. I started my career in traditional finance. I've been in crypto for quite a while. Creating integrated financial markets is, in my mind, the original vision of Bitcoin and blockchain, and it's something which is very core to the strategy, within Solana, and something we're very focused on at Solana Foundation. I think that having a very robust and unique sort of set of financial mechanisms is, in and of itself, interesting, unique, and an area of innovation, but also necessary for all of the other sort of decentralized applications that we may envision in crypto to really sort of be at their best.
Hi, everyone. My name is Sergej Kunz. I'm co-founder of 1inch Network. My background, I'm software engineer. So what we do at 1inch in terms of like stable tokens or any tokens in general, we aggregate the whole liquidity in the market on all like 12 chains right now. So if any stable token or any token launch somewhere, you can get it through 1inch integrations, MetaMask, Trust Wallet, Binance Wallet, Coinbase Wallet, some other wallets, and also on 1inch directly. So we solve the problem with where I can get the liquidity. Yeah. And the second thing, we try to adopt also crypto. One of our products that we launched like a month ago is 1inch together with banks and MasterCard. The crypto MasterCard, where you can just spend your crypto, also stable tokens, and get also cash back and stable tokens or Bitcoin or other tokens as well.
Amazing, thank you. So I want to start with kind of the state of adoption of stablecoins, and I'm going to turn to Anthony and Stef because you're between traditional finance and crypto, and what do you think is driving the adoption of stablecoins, and where are we with stablecoins and RWAs?
It's a major question, right? It's a big one. Not easy, but it depends on the counterparty, right? I think today we're seeing two major use cases. It's payments and it's composability on chain, in all honesty, and it highly depends on who your counterparty is. When it comes to payments, it's cross-border, instant. Depending on liquidity, it can be over the weekends and all kind of stuff, and I think that's interesting, which is applicable to the remittance space. We heard Ripple talk about that, so that's huge. And then when it comes to the other side of the spectrum, which are more of the crypto native sides, it is used as a ways of composability and either generating yields or looking for capital efficiencies on chain. The majority of activities today, especially when it comes to the more crypto native side of things, is credit, lending, and trading. On the other side, it's payments. On the payment side, operational excellence is key, which means relying on banking systems and relying on liquidity providers being able to tackle that really well. When it comes to on-chain composability, it's managing counterparty risk, smart contract risk, and doing that at normal yields, not chasing the crazy stuff that is out there.
So I agree with Stef. I think it's, payments, and I would say more specific imposability is yield on chain. I will say I'm a bit disappointed on where we are in the adoption cycle. We have a better technology for payments. Every transaction is traceable eventually, as we proved with all the seizures that the FBI has done with Tether. So we have this better technology. We have a better way to move money around, but why aren't we adopting it? And I think the U.S. specifically has been very slow to come up with any framework at all, let alone restrictive regulation that we see in some jurisdictions. And I think this is an inflection point for the U.S. because most dollars sit outside the United States anyway. And with Hong Kong, now Europe, UK, all starting to pass regulations on how they want to use the dollars that they control outside the country, I think the U.S. doesn't have as much time as it thinks it does if it wants to dictate the terms of how dollars are moved around the world. As far as the yield-bearing side goes, I would say I'm wholly disappointed in the product itself. We were just talking about this before.
Say it. How disappointed you are.
I just, the biggest challenge with a yield-bearing stablecoin is you're paying away all the yield. So how do you make any money, right? And it's fine initially for adoption, but I think that too many of us in this space and the crypto founders fall into this trap of growth and revenue. Like someone was talking about, I'll pick on Ondo. Someone was saying Ondo makes $9 million in revenue. You're like, that's awesome, but they pay out $10 million in yield. So what's the point of reducing the revenue number? So I think finding an economic model on the yield side that actually makes sense is, I haven't seen one yet.
So that's so interesting what you say, because it's really the clash between traditional finance and crypto-native tokenized incentive models, right? And so what we've seen in the space is banks, not Forge, but other banks doing, private blockchain as opposed to leveraging the public blockchains. I want to turn to Sergej and Lily on that. Have you seen projects that bridge the gap between those two? And how do you actually start to have the conversation with more traditional players who may not want to go the full decentralized route?
So I learned something recently, which is that Coda from R3 is alive and well, and they have annual conferences. That's amazing, right? And so to me, there's the market for enterprise finance, you can do a POC, that type of thing, is very much alive and well. And I think, we're now the third cycle is private blockchain, and there was securitization, and now we call it real world assets. It's essentially the same thing that people have been talking about for 10 years, right? And every cycle there's kind of like a new narrative and a new wrapping around it, and there actually is real progress as well, right? So I don't think it's just sort of a repackaging. I think that with each of these cycles, the first cycle I was a part of with private blockchain 2015, the narrative is very much Bitcoin bad, blockchain good, right? So we've already come a massive way where now, traditional finance has embraced, I don't know how many ETFs out there, right, in terms of numeric count. So there's tremendous progress, and I think that when it actually comes to running the back-end infrastructure, there is a market open-mindedness around having eventually having open network infrastructure be a part of, an asset manager's, company ecosystem, whatever it might be. But at the same time, I think there are quite a number of questions that people obviously take a lot of time with, right? Because the most sort of extreme sensitivity is you want to make sure that you're not touching a transaction that's been touched by a red line party, right? That's of course very important, and because that's such a bright red line for folks, then people do want to have, at least starting off, sandboxes that are running through their own internal comfort with this, a sandbox, private, whatever environment, right? So something that we're thinking explicitly about at Solana is how to have Solana permissioned environments, and then how to architect sort of a smooth transitioning and optionality to bridge that into, to redeploy that into a public environment, right? In the same same way that that you typically will deploy in testnet, and it's very easy to then deploy on mainnet, to make it that degree of ease and transportability. So that's one of the things that we're thinking about. And I say this as someone who came into this space very much as a public blockchain sort of maxi. And so I will say it took myself 3 cycles to say, okay, well, we do need to be very pragmatic about this. And so that's something we're actually, as like a big product priority for us.
So from my side, I need to say we don't need to breach them. The thing is, banks create own private permission blockchain because they have fear to operate on a mainnet. Because they think, I fully agree, they think they can touch some malicious actors, liquidity, and like dirty liquidity, maybe hacked liquidity from somewhere. From the compliance point of view, it's a nightmare to have something like in own environment, especially for bigger institutions. But what we need to do is to take the fear from such institutional. You can operate on a mainnet in a fully compliant environment. It's possible. It's the question is how you build it, or maybe someone can build it. So we, from our side, we are working on this already a long time, and our fusion, maybe if someone tried it out, it's like decentralized Nasdaq approach. User create an order, and then only compliant KYB market makers can execute on the trades. So we have already something in place, and theoretically it can also work for just only institutional environment, and they can have also access to the clean liquidity, highly efficient, and don't need to create own sandbox, because it's a really huge problem when you build own closed ecosystem. And it's not composable at all. So the whole DeFi, the whole Web3 is about composability. Yeah, composability you can have also in permission environment with only clean players, verified players, compliant players, but it doesn't need to be run in own sandbox, own extra blockchain. What like makes no sense from our point of view.
Yeah, so I think the conversation, private blockchain, public blockchain, is not the bigger issue. I'm obviously the oldest one up here, so I've been in Wall Street for 20 years, and I was around when markets got electronified and when the FX markets became centralized. Before that, people used to pick up a phone and call each other for a price. Wall Street acts as that like centralized exchange, so take equities out. Every other market trades OTC between clients and dealers. So what I'm looking, like the sign that the traditional markets are moving forward is when there's a consortium built where the pick-up chain doesn't matter, but that they all coalesce. And what's the stablecoin that's going to be used for settlement? What assets are we going to tokenize to settle, and what are the locations we're going to do that? And the technology is somewhat immaterial until they all decide to get together and do it. SocGen is not going to use Goldman Sachs' settlement system. Citi's not going to use JP Morgan's Onyx, right? It's fine that they're sandboxing, but we won't really see progress until the consortium build to get to a centralized model.
So that's interesting. I think Sergej mentioned that you have to have enough greed to overcome the fear. The question is there really like a business model in that space for enterprise in order for them to totally embrace the public blockchains, or at least enough cost cutting or cost savings in order to do that?
So first of all, you get very transparent settlement. So you can verify that there were no 10 parties in between who cut also on your rates. Yeah, when you do the settlement. And theoretically, like I hope, at least in the future, to see also stock trading on a blockchain, settlement on a blockchain, because it's much easier, more efficient. There are no humans in between. It's just program what is high available and highly secured. And yeah, this is like it removes high complexity. So just imagine like if I would like to buy a huge amount of stock, Tesla stock, I have 200 millions of US dollars. I can go to one exchange and exchange there, but I will face huge price impact. I need to look for OTC or market maker who split in small pieces, exchange everywhere, or use multiple OTC desks. A lot of people are in between. And like based on Murphy's law, like if something can fail, it will fail. And very often it fails on a humankind. Yeah? People make failures. So we can eliminate everything like this and use one nice platform, blockchain, what can just work as an application without kind of additional risks and have great transparency.
I do think that there are business models. I think if you look too closely and look exclusively in the arena of fast and cheap, right? It's too first order, and that's very rarely where innovation actually truly delivers value, right? I think that is true. For example, if you looked at the early days of the internet, everyone thought, well, it must be some media company which is going to be able to deliver their content faster and cheaper. And yes, it is true, the newspapers got digitized, but what was the real innovation? It was long-tail content creation, individual content creators, eventually social media, and that was really the media revolution, not just putting the Wall Street Journal online, although that happened as well. So I think similarly here, it's not only that the back office will be settled faster and cheaper, and complex trades, instead of T+30, T+ whatever. There's absolutely value in that. But what I think it also is it expands, it reveals, organizes, and helps monetize a much longer tail of of demand for financial products, right? So currently, if you're fundraising for a private equity fund, you may have a very high minimum. Now, some of the reasons why you want to have a very high minimum is you want to control who's in your LP base, so on and so forth, ongoing costs of maintaining your investor base. But then also part of it is it's just a whole lot of work to be able to accept, process, sign paperwork, negotiate, et cetera, with all of those investors, right? It's the shoe leather cost of actually transacting. Now, if you have an asset management platform where you have tokenized assets, you can potentially drop that minimum, if you so choose, from maybe it was previously $1 million, now it's 100,000. And so the fast and cheap is not just about fast and cheap, and you say would have cost you $100, now it's 10. It's about your ability to actually potentially organize, reveal, and monetize that demand for that asset at a 100K ticket instead of $1 million ticket.
Let's also talk about data protection or privacy, or optional privacy. Like, all of this is super great, and I think we're going to get there, but unless we have a technological solution in a permissionless environment that facilitates you being in somewhat, not sharing everything you do on chain, it's great transparency, but, when you start, managing everything on chain, there's a bit signaling, let's say, aspect to all of your actions. If we can build that in, that's when you're really going to attract size. Before that, it's just experiments.
So that's really interesting. I wanted to ask the panel, what impediments or what barriers need to be lifted in order for the thesis to come true that everyone moves on chain. We see a lot of development in the ZK technology that will allow for shielding of that information in a compliant way in the future. So starting with Stef and others.
It's exactly that, and I think there's amazing stuff happening. What's important though, and we're talking here about bridging the gap between TradFi and crypto natives. The regulator is very important here, and it's them understanding that ZK technology is not per se privacy and bad. Like, so if you can educate the market and the regulators on that front and find a pragmatic solution to what actually data protection versus privacy is and what the means are for which you need it, if we don't have that covered, it's going to be even harder for big entities to come in. So that is a very important part, not just the technological side of things, but actually how that is being interpreted by then the regulator.
I totally agree with the need to reframe the conversation around privacy. When people talk about privacy on blockchain, everyone's mind immediately goes to Tornado Cash and all sorts of red lines, an entanglement of red lines, right? When in actuality, blockchains are far too transparent. If I were to tell you, I've got a great idea for you, why don't you take your bank account and hook it up to your Twitter account, so every single time you swipe a card, it's just going to live tweet, okay? And don't worry, it's redacted. I'll blank out exactly who you paid, right? Or blank out every other letter or something like that. It's cool, right? No one would go for that. And we would all say, hey, that's a violation of just basic consumer financial privacy, right? And yet that's effectively what's happening on the blockchain if and when there's actually real consumer usage of a blockchain-based asset on a daily basis for actually payment. So if we actually get what we want, we're not going to get what we actually want. And so to reframe the conversation around privacy, yes, there are the edge cases which are scary. Absolutely, those exist. But I think we need to reframe the conversation around privacy as how do we take this blockchain world, has all these various benefits in terms of efficiency, composability, access, so on and so forth, and actually just make it such that the technology out of the box can adhere to our same existing standards on consumer financial privacy.
Just to add to Stef's point about privacy, so just take an example of what happens every day at a bank. XYZ central bank wants to buy $1 billion of 10-year notes, right? The reason they call up a desk to do it directly is because there's an amount of time where that trade doesn't get reported, right? Why does that trade not get reported right away? Why shouldn't we report every large transaction immediately? Well, when everybody else sees that a large trade just got done, what do you think they're going to do? Right? They're going to move the position against the person who actually won the trade. So anybody who's an LP who buys or sells moves large amounts of capital doesn't want that. The client doesn't want that. So until we can get that level of lack of clarity or lack of transparency for that specific reason, banks won't move on chain because they won't be able to provide liquidity at the same prices.
We're building an OPSEC team. Just a team that does nothing else than just managing funds on chain in a manner that does not share intent or any type of relationship between entities. Like, think about it. Like, it's just so complex because we're working with major foundations. They'll ask us, if we send you 100 million on chain, what is going to happen? We have to take that into account. So it's great to be transparent, and that's why we all fell in love with this industry and the technology set, and that's why we're all here. But in order to get like the real big players out there who send billions out there on a daily, not hourly basis, we're going to have to figure something out on that front.
I mean, this is where regulation has fallen down, right? Because what he's afraid of is people front-running you. And if you see every trade instantaneously, they'll front-run you, but we don't have any regulation, so it's not illegal. Right? Or maybe it is, and most people don't get caught. But that's the real cost of not having regulation.
Yeah, it's privacy. Privacy is a difficult topic since Tornado Cash, I would say. So now we know that you can go into the jail because you wrote code. What helps other people to launder money? This is the current situation. This is the law. If you can also charge into money laundering without like actively doing something, but like doing something what helps them. It's in every European country the same, I guess. Yeah, we need to fix this for sure, and it's really a hard topic, I would say. Also, this is like trade-off. From one side, we have like bad actors, terrorists, North Koreans, hackers, who launder money for nuclear weapons or whatever. From other side, to go forward with the institutionals, in general with the adoption, we need also privacy. I fully agree. I don't like to share my private accounts at all. Where I paid with my card and why. Yeah, it's political thing, and maybe we need one more generation of politicians to fix this. Maybe.
Yeah, a younger generation. So that's really interesting because privacy is something that institutions want. We trade dark pools, we do a lot of things, and we love that. And then we love the blockchain data because you can get a lot of insights from it and actually create trading strategies and things like that. But there's a lot of innovation in that space, and I think it'll move forward. Do you guys remember when it was the intranet and the internet, when people didn't want to put their credit cards on the internet? I think we're at that moment where we're trying to solve all these issues with the public blockchains, with institutions, with regulators. So an interesting time to see where the adoption is. So I want to narrow down on stablecoins. and have your perspective on the key use cases we talked about earlier. But how do you think about stablecoins and CBDCs and what that future looks like? Are CBDCs going to take over any private stablecoins, or are they going to live together? Is that a real use case in the future, or how do you see the future in Europe and the US?
I actually maybe don't even want to answer this question.
I think CBDCs are a bad idea.
There you go. Thank you.
I think CBDCs are the instrument of an authoritarian government, whether right-wing or left-wing authoritarian. And I think that we came up with Bitcoin and blockchain to combat that, not to encourage that.
So I'm supportive of CBDCs, but not as a token. I know that sounds funny. So I'll just give you an example. In Brazil, they've done a lot of thought about central bank digital currency. And what they came up with is they're not going to issue one. What they're going to do is issue a framework for private companies to create a stablecoin and use their banking rails so that, one, they set a standard of what assets can be invested in to back that stablecoin so they never have a default. And two, they allow all the different issuers to be fungible, right? So you don't have to create all these different pools between PayPal and MasterCard token. So I think that's a very reasonable step forward, but the government, I agree with my colleague here that I think that's a horrible idea to have governments issue. Now, the French Central Bank has issued stablecoin for specific transactions with the EIB that our host has been on the other side of for that point because we don't have a framework yet. But yeah, a singular issued stablecoin run by the governments is a terrible idea.
Yeah, from my side, can build on stable tokens. We should just make sure that they are liquid, not like printed out of thin air. And yeah, and if like government should not print money from our point of view at all. Yeah.
However, would you see a difference between wholesale stablecoins and retail stablecoins? Oh, sorry, CBDCs. Sorry, because the wholesale would be just between the banks, and then the retail would be a separate product.
Which bank gets issued a stablecoin?
I mean, I think that the various banks that are engaged in, for example, bank-to-bank, interbank repo transactions, whatever it is, they should all be able to issue their own wholesale stablecoin. So it would be, Bank A coin and Bank B, and to an extent, they reflect the credit worthiness of their issuer. So that, to me, would be preferable versus Fed coin.
So we see that it's interesting and discussed topics.
Just really quick, the CBDC would never work in the United States specifically because banks are the aggregator of deposits, and then they also extend credit for houses, small businesses, asset purchases. So in a world where the US issued a CBDC, no one would have the need to have a bank account. They would just have a wallet at the Fed paying some type of interest rate. So unless the Fed wants to become the credit mediator of choice, and cut out all banks, it wouldn't really work in the U.S.
I have one thing: if any bank or government starts to create a token like a CBDC or something, please come to crypto native people. We will help you to write the code, please. Our last reviews, so it's like a nightmare what we have seen.
So now I want to move the conversation to RWAs. Beyond tokenized bonds, what do you guys see in the market that is exciting to you? Because it doesn't seem that, we see a lot of big headlines, but it still seems to be at the fringes. How are you thinking about the space?
Well, I think that structured products is a pretty interesting space where it's not just sort of one-for-one. What happens in the traditional world can also be represented on chain necessarily, although that can also work, right? And I think you're already starting to see that with money market funds being tokenized on chain. And so I think that, so with regards to money market funds being tokenized on chain. What I think that opens up the opportunity for is kind of like the next step from there is then you could easily collateralize that, or you could collateralize kind of structured products and then be able to borrow, for example, either stablecoin or tokenized money market fund against that. So that's kind of like a very clear next evolution. So I think that's one cool thing where you start to have more additive activity and composable activity. And then I think the other is for me, crypto is really just about discovering new financial mechanisms. We did that originally with Bancor, introduced the AMM, and that's very much alive and well in many different, very many different parts of crypto today. And so I wonder, when it comes to structured products, what is unique that you can do on chain because you have everything sort of in this one asset soup, right? All sitting on chain. And I also think that in the same way that, at least in the Solana ecosystem, when we introduced the CLOB on-chain CLOB in 2020, we got this big wave of really high-quality talent from kind of HFT Chicago background, engineering talent coming into crypto. I wonder if there's kind of very talented structured product talent that is, turning little dials on ETF A, B, or C, right? In the existing world, that could actually come and rethink from a first principles basis what you would do in a structured products world in crypto, where you basically have all of these new possibilities in front of you.
I'll tell you what I don't like about the RWA market is tokenizing different forms of credit and then offering it to people. I don't think those products should be made available, and that's why we have accreditation laws in most major countries. The things I'm most excited about are, there's a couple of projects that are financing short-term credit factoring, so like a receivable for XYZ amount of days from a company that where the bank's cost of capital might be, what they charge to settle those short-term loans might be higher than what a retail person might want to do to earn that. To me, there has to be a reasonable expectation that this person can understand, like with tokenized treasuries, they understand US government, they understand the risks. So building products that we're not just taking advantage of retail.
You said, Lily, about this actually being around 5-6 years ago. They called it just security tokens at the time, which was the hype, especially on the Ethereum side. It's the same often, and RWAs, or tokenized real-world assets, they make sense if it solves inefficiencies. It solves and helps people do things more faster, or it helps save costs, etc. But if you then have to rely on an on-chain liquidity profile, that actually makes it even more expensive because it's harder to hedge real world versus then on-chain. What's the purpose? It's been a great experimentation then, right? And I think that's good, and it's good to think about it. But the secondary market actors, like market makers and secondary markets, need to become way more mature to actually make the overall cost of execution attractive in order to really make this a thing. So it's good to experiment. The same with T-bills. Like, I think it's great as an experiment. Yeah, sure, and you can then collateralize it on Aave or something, and that's maybe interesting. But somebody wants to get access to T-bills, typically has access to T-bills because they got a bank account and they're an institutional counterparty. And those that don't have access to T-bills typically want to go for more yields and doing something on-chain native. So you're actually building a product that is exciting. It's great, and it's helping us move forward, and it's helping the conversation with the regulators. But I often wonder how many times they're actually solving a problem. So let's keep experimenting, but not do it wisely.
I fully agree. So we should look maybe for what pain we solve here. So just tokenize everything makes maybe no sense because there's no demand. So where I see this demand in terms of tokenization of real world assets is the Real T project, for example. Maybe someone know. You can buy tokenized real estate. It's like a house in maybe Detroit. Really looks terrible, but there are people who rent it, yeah, who pay every month, and you can invest already from $50. You buy a small piece of this real estate, and you can have many of them. So I bought a lot of them, so a little bit everywhere. And now if one house burns down, I still get payouts every week. So and the insurance covers it. And every year they update, for example, the price. So it goes up, the market goes up. Okay, my assets are more worth. And this is really nice. So I get every week in USDC payouts. I use this. I pay for the coffee or whatever. So this is a real use case. It's comfortable for me as investor to invest. I can invest also in fiat. So I pay fiat, I get tokenized, really ERC20 token. I can put it in a Lightning protocol. I can leverage it if I want. So I have seen a lot of crazy things happening with these kind of tokens. And it's easy, it's useful, and I get directly benefits. I don't wait like 1 year for the payouts. So I get every week, and everything's cool.
Yeah, there's another real estate project called Realty that also allows you to get tokens and then trade them on Aave, for example, after and get yield. But that's not the majority of the RWAs and tokenized assets that we see. We see a lot of banks tokenizing assets on private blockchains with no liquidity and no market to trade them, right?
Who needs it? Yeah, this is the question. The experiment, I have the feeling sometimes like institutionals, also traditional companies. I was working for Porsche, for example. They just misuse blockchain. So in the way like as a database or something. And yeah, speak with crypto native people. We have seen multiple solutions and more efficient solutions, and we have seen already with Banker and Uniswap and such innovations as automated market makers, what was not existing before. This is kind of new approach for the same problems you had in the traditional finance, but much better, much efficient.
Yeah. So before we open up for questions, I'm going to ask one last question to our panel. What's your midterm vision for adoption of stablecoins and RWAs, like 5 to 10 years? Where do you see the future and what's exciting to you?
Permissionless on-chain FX markets through UniV3 or some AMM. Not actually
you have
direct
the
market.
alpha here.
Sorry?
You get the alpha in this panel.
I think if stablecoins are successful in 5 years, though, you won't even use a stablecoin. It'll be abstracted away from you, and it'll just be part of the infrastructure that moves money around. And I think that's probably the real sign of success. I will say, I don't see any credit card companies in the room. I'm wondering why they're not part of the conversation, because they're the biggest, stablecoins are the biggest threat to their business line, right? They only have 2 business lines, 3% in payments and a bad debt portfolio, which seems to be getting worse more recently. So if the payments are free, how do they subsidize those debt portfolios?
I think it's going to be around PayFi. So PayFi, to me, is new financial mechanisms based around a settlement layer. It doesn't exist right now in crypto because it hasn't been possible to build because we haven't had a scale, programmable, and also performant chain until what you have now is Solana. So.
I think we will have more usage of stable tokens. So right now, you can already buy in Dubai a car or apartment with USDT. It's possible. Cross-border payments already happening. So we see already a lot of adoption of stable tokens. From malicious actors. Yeah, I see more adoption, and also kind of it's a good example of the MasterCard and Visa payment provider. They will potentially also use it more.
All right, thank you so much, guys. Any questions in the room for our crypto native panel?
Hi. Do you think fully homomorphic encryption can help solve the privacy issues that may bring the traditional finance on blockchains? First question.
I don't have enough technical knowledge to answer that question.
So I can give you some insight. We look at FHM, and there's a lot of like solutions out there. The issue, I think, with being at the bleeding edge of innovation is that if you issue a token or protocol, it's very hard for the companies to include that or build on that. So you have to find a product or a technology offering that they can include in their own products.
Okay, second question on the liquidity on real-world assets. So what are the next step solutions that will actually bring liquidity to secondary markets and actually bring a whole scope of various RWAs that can't really work at the moment?
More entities like us who have the capacity to trade both on traditional markets and on-chain markets and have that knowledge. So that is the support of regulators, licensing clarity, etc. And then matching the actual demand towards the secondary markets where they're active on. So making actual use cases for RWAs instead of experimentations. But the former, for entities like us, as market makers, is key in order to access and give good pricing. Otherwise, it's going to be inefficient and slow.
Use cases and we are, as soon we start to solve problems instead of experimenting, I fully agree, we will see more.
Any other questions? So with that, thank you so much. I want a big applause for our panel.